I'm Michelle McCory, and we are back with Matthew Piepenburg. Matthew is the commercial director at Matterhorn Asset Management and the author of several books, including Gold Matters, Real Solutions to Surreal Risks. Now, Matthew, before the break, we were discussing the LBMA, the London Bullion Market Association, which you say has played a role in manipulating and suppressing the price of gold. You're not alone there. Many agree with you, including Russia's finance minister, who says that there needs to be an alternative to the LBMA to counter the LBMA's price manipulation, as he puts it. Now, as I mentioned at the top of the interview, Russia is proposing its own international standard for gold and other precious metals, the Moscow Gold Standard. And Russia is claiming that creating the Moscow Gold Standard is critically important for normalizing functions of the precious metal sector. I'm quoting the finance minister there. And the move, of course, is in response to Russia getting banned by the London Bullion Market Association as part of the sanctions against Russia for its invasion of Ukraine. So if Russia does, in fact, launch this alternative to the LBMA, how significant would it be if they succeed?
Well, it's a fascinating shift. And as we talked about before this interview, one of our colleagues and advisors at Matterhorn, Grant Williams, he came out with this, and we talked about this back in February, March of 2022, that what happened with those sanctions from the West was as big a watershed, not only in the currency markets and in now going from a mono currency or a world reserve currency to a multinational currency system, but also in terms of precious metal pricing and the petrodollar. There's been so many ripple effects of those sanctions, so many failed consequences of a failed policy. Again, not taking pro-Putin stance, but it was an absolutely myopic policy. It'll have a massive effect on the gold price because, again, whatever you think of Putin, whatever you think of a war, none of us are in favor of war, seeing civilians killed because of the ignorance, egotism, or needs of powers. But the simple effect is, Putin may be many things, but he's a chess player and a judo master. He's not stupid. He and Xi and China and Russia have been waiting for years for the pretext to reorganize the chess table here. They've been waiting to diminish Western influence, NATO influence, and the US dollar's influence on the European continent in general and the Eurasian continent in particular. Where gold falls into this play is, in addition to seeing what they think is the bullying of a U.S. world reserve currency, which has exported its inflation all over the third world and in the BRICS and in Pakistan, Lebanon, Argentina, Sri Lanka, all these countries who've been bullied by the U.S. dollar are looking for new partners, and they're looking for a new system. And part of that is looking for a new LBMA or a new gold exchange, because Putin and Xi and others are very much aware, like anyone who trades precious metals honestly knows, that the LBMA market and the COMEX and the OTC market and the forward contracts leverage is an artificial, legalized way of repressing the paper gold price. So it's not normalized pricing of gold. It's not a conspiracy theory. I even knew this before I became a gold bug or gold interested. When I was working in Wall Street, we all knew this. But in terms of the gold exchange and the LBMA, Putin, like many of the things, has known that the West, he's been patiently waiting. Modern monetary theory, the idea that you can solve a debt crisis with more debt and then pay for that with mouse click money, was once a fringe concept in the US or in the West. Now it is mainstream, and it's an absolute insult to the notion of money as a store of value. Now it's just a medium of exchange. Russia and the East are thinking, no, we like things like fertilizer, gold, and hay and hard assets. And they're saying we need to reprice and normalize the pricing of the LBMA market. It's one of the many sins of the West that they want to correct. Now, whether they succeed or not is another question, but it's no coincidence that the Moscow World Standard has popped up in addition to everything else as we de-dollarize, as the petrodollar gets diluted by other exchanges and other trades, that they'll do the same thing with the gold market because it is real, it is a monetary metal. And so the Russian finance minister is now proposing that these Eurasian banks start creating their own standard for gold, that these committees come together and they bring in, whether it's an aggregated or monetary national unit, they're going to reprice physical gold more fairly. Because Putin knows, like everyone else knows, that the LBMA is an open joke. It's legalized use of leverage to artificially repress the gold price. So again, when you look at 8 LBMA banks effectively having thousands and thousands of levered contracts short when most of the market is going long and the gold price is repressed, that's not fair gold pricing, regardless of whether you're a gold bull or not. And one of the things that the East in general and Putin in particular wants to do is compete on this level too. They've seen the US and the West bully and use the world reserve currency to force other countries like Argentina to have a 70% interest rate to try and pay back their dollar denominated debt. Well, now they want to also be the good guy when it comes to gold pricing and real assets like gold. It'd be very interesting to see that. If you were to use the Moscow World Standard now and where they're pricing gold in rubles, that would have the dollar equivalent of gold at about 2,500 right now. So they're trying to, again, show that they're going to be a more fair, more equal, more normalized standard, because natural supply and demand has been destroyed by criminal levels of leverage at the COMEX and the OTC markets. And so it's not a surprise at all, in addition to every other ripple effect, from the world reserve currency to the declining influence of the West to the declining power of the US dollar, inevitably, that they want to come up with a new gold exchange. And again, whether it's successful or not is to be determined,
Right.
but it's not a surprise.
Well, that's just the point that I want to see you try and address, is how likely is it that it can be successful? Because they do seem to be galvanizing a lot of support. We've got President Xi Jinping meeting with President Putin just this week. The finance minister of Russia says he wants to make membership in this organization attractive to all market participants, especially China, but also India, Venezuela, Peru, other South American countries, as well as Africa. Of course, in order to, as you say, destroy the monopoly of the LBMA and provide for a stable development of the precious metal sector, as he likes to say it. Now, it feels like the LBMA has been around forever, but it's only been around since 1987. So in that grand scheme of things, if you look at it, something could surely take over. Do you think that the Moscow Gold Standard can actually succeed?
I think it has real potential for real legs. I mean, 60% of gold is produced on the Eurasian side of the continent. 70% of that gold is refined in Switzerland, where I work, but most of it comes from the zone that's going to be under this new Moscow World Standard. And you have to understand that Russia's largest non-energy export is gold, or production. So it has a vested interest in seeing gold more fairly priced. I think all those countries that you've listed that aren't friendly or necessarily under the influence of a bully like the US government or the US market or the LBMA market in the West are looking for any pretext to push that bully out of the playground and finally have a fair exchange of their marbles. The kids want to play fair with their marbles. The LBMA and the West have been bullying them for decades. And so if the Moscow World Standard can create more fair pricing, countries that have been bullied and beaten by this LBMA market, who haven't seen a fair price discovery of the gold they mine or the gold they produce or the gold that they save, are going to be more than eager to turn their backs on the LBMA market if there's an alternative. Again, that is a slow process. But again, to the point that Grant Williams made, I think what happened in 2022, this first quarter, was as much of a watershed as what happened in August of 1971. So many changes are coming, and they're not going to be. There's no going back. The genie doesn't go back in the bottle now. Even if there was peace tomorrow in the Ukraine, the world has already seen that Russia and China in particular, but all these other emerging market, or if you want to say third world economies that have been beaten down by US dollar denominated debt and beaten down by mispriced gold, are going to be more than eager to try and find fairer pricing and a fair monetary standard. It'll be very interesting to see how the LBMA reacts if we do have a Moscow World Standard that is giving higher pricing to gold and more fair pricing. They're going to react unfavorably to an LBMA that continues to use margin and leverage. I also think the fact that we have rising rates right now, banks that are 10x levered in the US, the big LBMA banks, or European banks that are 20x levered, will use rising rates to delever. They have to delever. European banks, when they had negative nominal yields, couldn't delever. Now they can delever. So that will contract the derivatives market in general, which has been expanding since 1985. As the derivative market contracts, even the LBMA market will contract. We have a real chance now, after many years, to see somewhat better fair pricing of this completely disingenuous LBMA market. So it'll be a very interesting next few years if this becomes real. I don't see any reason why it won't become real. Russia has
but your timeline anticipated for this?
Gosh, I mean, again, predicting it's not trying to escape responsibility. It's such a mug's game. It's such a mug's game. What the French finance minister do, how they'll get these Eurasian central banks to cooperate, how they'll price it, whether it'll be an aggregate or country by country monetary unit, will be interesting to see. It could be within 2 years or less. And even if there's peace in the Ukraine, I don't think these changes can be stopped now. There is a sense, they say in German, ich hab die Nase voll. When you're fed up, at some point you break. The camel, the last straw.
Right.
The rest of the world is seeing an opportunity for fair pricing and less Western hegemony, whether it's NATO in general, the US in particular, or Western currencies in general, the US dollar in particular. The rest of the world is saying enough. And I don't think that's going to change now. And America has to be ready, not for the end of the dollar or the end of the world or the end of the US markets, but they have to be ready for the end of an era where they could dictate policy, dictate currency, and even dictate false artificial pricing, or even manipulate supply and demand in the commodities market. So I think that will be fascinating. And the combination of a declining dollar, a contracting derivatives market, and a rising Moscow world standard is going to have longer term impact on the prices of gold and silver, which have been held back for far too long. And again,
Right.
to us, gold is just is just insurance for dying currencies. And whether it's at 1700, 1600, or 2200, long-term investors don't mind because they see the end game here. And gold will hit much higher highs. It's, again, not a gold bug comment, just common sense and watching the geography and the history and the math of currencies play out in real time right now, which is incredible what's happening this year. Incredible.
And as you say, that big watershed moment happening in February of 2022, when the dollar was really weaponized.
Yeah.
And we saw Russia taken off the SWIFT standard. And of course, we've seen how the ripple effect there. But given that gold is priced in dollars, that's obviously not going to be the case for the Moscow gold standard. So
Right.
the question is, how are they going to be pricing their gold? And one of the solutions out there is to have precious metals prices fixed by the national currencies of the key member countries using the new monetary units used in trade. So, for example, this new BRICS currency, which has been proposed by Putin. The BRICS, Brazil, Russia, India, China, and South Africa, they're developing a new basket-based reserve currency.
Right.
The presumption, I understand, is that it will comprise of real, rubles, rupees, renminbi, the rand, and present an alternative to the IMF's special drawing rights. But there's also speculation, Matthew, that the BRICS currency will be backed by a basket of commodities, including gold. And that's when, again, this gets very interesting. So how do you see this playing out?
Well, first, there's so many levels to that. First of all, it's important to know when we talk about gold in the US dollar, when we talk about the repressed gold price, you have to keep in mind, even this year, gold is only down in terms of US dollars. Other major currencies, developed market currencies, gold is positive to flat for the year. So it's only been a disappointing asset in the US dollar because the US dollar is so strong. As demand for that US dollar shrinks and as demand for this new system in the BRICS system and other emerging market economies rises, I think even priced in US dollars, gold will rise. But the larger question you're asking is, how does this play out in this new world order, this new reset? The IMF has been talking since COVID in 2020. They were already telegraphing a central bank digital currency and a reset, comparing COVID to World War II when 85 million individuals died and the economies all over the world were ruined. The absolute arrogance of comparing whatever you think of COVID to the devastation of World War II, and any of us living overseas who have family or memories of Europe can certainly say, as frustrating as COVID was, it doesn't compare to the IMF's definition of World War II's crisis. But nevertheless, even the IMF said that as we go to a central bank digital currency in the near future, and as we go to a reset, even in their own diagrams, they recognize that part of that new blockchain-based digital currency, which has all kinds of ramifications for personal liberties and privacy and all that, which we won't get into. But even if they go that route, they've admitted that for that new currency to have any credibility, it has to have some partial coverage in real assets. And by that, they mean gold, physical gold. Because otherwise, it's just the same music, a different band. It's just another repackaged fiat currency. So as the West and the IMF try to come up with a central bank digital currency, which will not be orderly, because China and Russia and the BRICS are now going in a totally different direction. Again, this goes from that monopolar to a multipolar or bipolar world, not just in terms of alliances politically, but in terms of currencies and finance and the dollar's hegemony. All this is going to be radically different. I think even with the Moscow world standard, it's going to be a similar aggregate, of these different currencies and these Eurasian banks as it was with the BRICS. It'll be very interesting to see how that plays out, because the real and the rand and the rupee are different and have different values. But if they're free floating based on economic indicators rather than margin and an LBMA market, it'll be interesting to see how gold is more fairly priced based on the balance sheets and reality of these countries.
Matthew, why would the West and the IMF want to have gold play a role in a central bank digital currency? I get why Russia and this potential Eastern alliance would want that to give legitimacy to a currency, but having gold backed or gold play a role for the West and the IMF, that would nullify that mouse click money that you like to discuss. So would they be forced into that because of the Eastern currency paradigm that's going to be backed by gold? Would that be in response to that? Because I wouldn't see otherwise why they would want to curtail the ability to click and print, as you say.
Well, look, I had teenage children who liked to throw parties whenever I left the house, right? They didn't like a chaperone at the house. And for years, the West and the US in general have loved not having gold as a chaperone. Since 1971, when Nixon welched on the global gold standard, it was a way to have unfettered euphoria with the US dollar in control. They didn't want a gold chaperone. Why would the IMF want to add a chaperone to the party after years of debt euphoria? I think it comes down to currency. I mean, it comes down to politics and optics, because when and if it's needed to have a restructuring of the currency system, and again, I'm not talking tomorrow, but when and if that becomes necessary, even the most average investor now has lost faith in central bank optics and doublespeak and forked-tongue excuses. For them to have any kind of credibility, it's going to be like a Western Chapter 13 or Chapter 11. They have to restructure debt. Again, it will never be 100% gold-backed. But whatever that coverage ratio is, whether it's 5%, 10%, or even 20%, that's going to have a massive tailwind for the gold price. But more optically and politically, they know that they can't, again, play this magic trick of saying that the new central bank digital currency is going to somehow be fair when it's backed by nothing but the full faith and credit of the central bank digital currency and the IMF. That's just replacing one bad horse with a bad mule. And it won't really solve the problem, in my opinion.
Well, Matthew, there are those that argue that this is where Bitcoin comes in, that central banks may incorporate Bitcoin into this currency or to create more legitimacy, if you will. Do you see Bitcoin playing a role with gold? Do you see Bitcoin playing any role? Do you see Bitcoin playing a predominant role?
Again, I think people expect as a gold executive for me to just make it a zero-sum argument and poo-poo Bitcoin and laugh at Bitcoin and deny Bitcoin. I don't think you have to be a gold realist and an anti-Bitcoin or anti-crypto person at the same time. I mean, Ronnie Sturfeld, one of our advisors, believes in both. I think it's tragic, though, in a lot of ways that Central American or poor countries or debanked countries like in Africa or Central America who've been bullied by the U.S. had really no choice but to consider Bitcoin as a way to create some type of store of value in their otherwise, I think, handicapped or kidnapped currency markets based on Western policies. What I have to say, though, is I respect, it's so many levels, the intellectual argument behind cryptos in general, or Bitcoin and Ethereum in particular, that it's a fixed amount, it can't be printed, it can't be expanded, it's more honest than central bankers, West or East or South or North. But I think
Bitcoin.
Not only Bitcoin.
But I'm saying only Bitcoin has the fixed amount.
Only fixed one has the big amount. But I think the problem with Bitcoin is so manifold. First of all, it would be a bigger threat to these governments than even gold. So they would find ways to come up with reasons not to use it. I think Bitcoin has a standard deviation of 140. Gold has a standard deviation of 17. People say, well, that's just because it's consolidating, it's finding its legs. At some point, Bitcoin will mellow and reduce its volatility, and it'll have real credibility. But the standard deviation of 140, I don't see how that's a stable backdrop for any system, emerging or developed. And again, that may be argued by the Bitcoin camp as temporary, and eventually it will be more honest and loyal than the dollar or the central bank dollar, which I think is easy to be more honest than the US dollar. I don't think it's realistic. I think the power of Bitcoin is it's also its biggest weakness. The fact that it can skyrocket and tank in the same breath. And I think that's not just temporary. I think that's the nature of the asset. And again, this is a bias, but we work in Switzerland. We see a lot of high net worth clients. And I've seen more than one Bitcoin millionaire want to convert his or her Bitcoin into gold because they know what we all know, that Bitcoin is a speculative asset. It's a trade. Believe me, I wish I'd had it. I wish I'd bought it more as a momentum trade. But I don't think it's a store of value. I don't think it's going to be a unit of exchange. And I know the Bitcoin camp will consider that blasphemy. And I could be dead wrong, by the way. I don't want to see Bitcoin investors fail, but I don't consider it the stable store of value. Gold is a lot less sexy than cryptos were for many years. But gold, I think, is a lot more stable. It's a better spouse than the Playboy polo player. And I think that's kind of what Bitcoin is. And yet, I could be wrong. And I don't need to even be right or wrong because I still think gold emerges as a victorious asset regardless. But I have too many friends who are in Bitcoin who have been stressed to the point of no return because they were chasing return, but not thinking risk management. At the end of the day, gold is boring. It is a risk management tool. It is an insurance for openly dying currencies. And the fact that the DXY is at 108 is such a short-term blip, and it's such a seductive notion that this is permanent, but it's not. And so when the dollar tanks like every other currency, gold will do fine. And you have to keep in mind that since 1971, the inherent purchasing power of the dollar has lost 95% since 1971. So whether gold is priced in dollars or not is irrelevant. It's priced in grams and ounces to us. And it is a loyal, more honest currency hedge. or currency or monetary metal than the US dollar or the peso, the pound, the won, or the yen. Again, not exciting, not near as exciting as Bitcoin. The short answer, long answer, Michelle, is I wouldn't see Bitcoin as a new currency system in any major economy in the future. I just don't.
Wow. Playboy polo player, fake watches as real as a Rolex bought on 42nd Street, horses in the glue factory.
Yeah.
You have some runners drinking martinis instead of water. You have some very colorful metaphors there that are certainly going to linger with me.
All right.
But very big picture, Matthew.
Mm-hmm.
As you quite rightly said, every fiat currency has been debased. That is just the reality. And as you say, slowly, then suddenly, what is inevitable is not necessarily imminent.
Right.
But I'm going to put you on the spot here. What could be the tipping point that goes from slowly then suddenly?
Well, it could be the changes in derivative markets as rates rise and derivative markets contract or credit markets contract. I mean, the Federal Loan Officer survey shows that credit is declining. The derivatives market is contracting as interest rates go up. Those are emerging markets could start defaulting on the US dollar because they simply can't stomach, they're stretched too thin to pay back those dollar denominated debts. So they either default or they look elsewhere. So I think any one of those three could be a tipping point. And there's always the unknown black swans, a political assassination, a breakout of some horrible extension of this war or something that we can't predict. But the system, the financial system, the banking system, the credit system, the monetary system is so fragile. The known or unknown straws that can break this camel's back are everywhere. It's like a bubble with a million needles pointing at it. And it's just a question of which one hits it. I can't predict it. I think the risk in the credit markets, I think the risk in the emerging markets, and I think the unsustainability of the US dollar are three obvious factors that could send this tipping point over the edge. The other geopolitical gyrations and movements are like currents in the sea, picking the right wave. It's hard to know which one that will be. But to me, it's as inevitable. It's as inevitable. And to time that is impossible. But I don't see how we can avoid this. Again, to use a metaphor, you can't have 18 martinis without a hangover. You can't pretend that you can solve a debt problem with more debt paid for with money created out of nowhere. That has ramifications. And the only thing that the central bankers and policymakers have done is buy votes and buy time with fake money. And I don't know how long that can last. But what scares me the most, historically speaking, from the 1920s in Spain and Germany and even in Italy, you saw what we saw in every moment in history. Whenever you have a country straddled by debt, you first see a financial collapse, a market collapse, a currency collapse. And this goes back to 18th century France, too. It happens every time, even in Batista's Cuba or in Venezuela or Argentina. Whenever you're debt strapped, you see this financial crisis, you see the currency crisis, you see the social unrest that always follows. And finally, you see extreme political centralization over your individual rights from the extreme left or the extreme right. And that, I think, is what's really scary, is what we're seeing. And again, that's a very political opinion, but there's so much evidence of governments becoming more and more involved in our daily financial lives, of which central bank digital currency is another example, because then you're monitoring your spending. But that's the tip of the iceberg to what we've already seen. I think that political shift to extreme politics and less individual civil liberties and rights and choices is a non-tangible, non-financial consequence of years of living beyond our means and using words rather than math, and using political talk rather than straight talk. I think any population would have respected a government that told them the truth rather than made up stories and excuses. And now we've gone too far. I think the real risk ahead is already being playing out since 2020. Less and less freedoms, less and less democracy, less and less natural supply and demand capitalism.
And of course, there's concern that the environmental narrative will be used as a Trojan horse to implement these controls. And we're already seeing some of that. Governments telling people how they can which cars they can drive and to what temperature they can set their homes. And when things are digital, it's very easy for governments to control it, especially with the central bank digital currency.
Sure.
So given all of this, and given, as you say, it's inevitable, why are we not seeing this sensibility, at least, reflected in the gold price? This idea is catching on, as you say. People are losing faith in the Fed. People are seeing how government is enforcing more and more controls. Why is this sentiment not being seen in the gold price yet?
Well, again, I think the gold price in the US dollar terms, that's purely based on the DXY and the relative strength of the US dollar right now, which is short term. I think also that there is, and again, it's not just the apology that we always use, but when you have open price fixing in the LBMA markets, the paper price of gold has absolutely nothing to do with the physical price of gold or the physical need for gold, the demand for gold. So I think those systems have to break first. The LBMA market has to either be contracted or outplayed by the Moscow World Standard, and the US dollar has to find its inevitable baseball up coming back to earth. It's going to happen. So I think right now, it's like saying, well, if it's rainy today, it's going to be rainy tomorrow. The fact that it's rainy right now in gold is only because the dollar is strong. That doesn't mean it's going to be rainy tomorrow. You have to be a long-term patient investor. And I think, again, to use a polo or a hockey metaphor, you always have to play where the ball's going to be, not where it is today. If the player in front of you does a backswing, you got to turn your horse towards the ball. Everyone is still looking where the ball is. I think investors in precious metals are already turning their horse toward where the ball's going to be. And I think they get the last laugh and the last goal at the end because they're seeing it play out. You have to think chess moves, not checker moves with precious metals. And people think that's an apology or an excuse for a low repressed gold price. I understand that. But none of the investors who bought at 500 or 300 or at 1500 or at 1800 or 1900 who come to us really worry about the daily price fluctuations in a gold price influenced by a bogus LBMA market and a temporarily strong dollar. And by the way, no, go ahead. I'm sorry.
So do you have an outlook that you feel comfortable saying? You're looking at the direction that the ball is going, where the puck is headed. Where do you see gold then in 10 years' time? What do you think is the fair value for gold? Where can we expect gold to be at 10 years' time?
Significantly higher than this. I think, again, Ronnie Sterflid did a study recently, earlier in the year, where we were just looking at gold coverage, whether it was the M0 or the M4 money supply, and whether you had a 10% or 20% gold coverage. I think we'll have at least a 15% gold coverage on whether it's a new central bank digital currency or a Moscow World Standard or a combination of that chaotic thing in the mess in the middle. It's very easy based on a 10 or 15% gold coverage to see gold at the M0 supply at 5,000 and then the M4 supply at 16,000. That's conservative. When you talk about $50,000 gold, that gets headlines, but I think that's unrealistic. That would require 100% gold back on the US dollar as currently priced. That's never going to happen. But I think global currencies are about to go through an absolute shocking moment of destabilization, and that's going to have epic, unpredictable price swings in the gold market. But I think 5,000 to 16,000 in the next 5 to 10 years is totally appropriate. But again, that's being measured in increasingly weaker US dollars. Right. If you measure it in kroner or francs or pounds or yen, it's a very different conversation about the gold price. Right now, everyone's worried because it's so low in US dollar terms. But that assumes the US dollar is that polo ball or that hockey puck that never moves. And it's so clear that there's a backswing coming, that ball's going the other direction. It's just a question of when. And that could be 3 minutes, 3 months, or 3 years from now. I think it'll be sooner. I think it could be when markets hit unbelievable lows and panic, because gold is emotional. It can be high or low in strong dollar, weak dollar, disinflation, inflation. But when people lose faith in their currency, in their central bankers, in their politicians, left, right, or center, when they lose faith in their media, when they lose faith in their talking heads and pundits, and they feel it on the streets because inflation is palpable, when that collapse in faith occurs, gold prices rise, regardless what the LBMA tries to do or what central banks try to do. And I think that's the intangible, unpredictable reality of it. But we've seen that again throughout history, from ancient Rome to the Ming Dynasty to 1789 France. Gold is emotional. And when faith is lost, gold rises because there are no systems that can compete with it. And I think the faith right now in the US and Europe, being a European American, it's not confirmation bias. I'm seeing that lack of faith everywhere, from sophisticated to non-sophisticated, from investors to non-investors. The distrust of the conventional narrative is not a conspiracy theory. It's just not believing anymore. And I think that loss of faith will be the intangible, real tipping point. But again, there's so many needles pointing at this dollar bubble and at this market bubble and at this debt bubble. Again, 300 plus trillion in global debt when GDP is 1/3 of that is simply comical mathematically that we've gone this long. And the fact that we've had this many martinis without the proverbial hangover fascinates me, but I've no doubt that no one can drink 25 martinis without the hangover.
All right. Matthew, what's your favorite metaphor as we wrap this up? I'm gathering it's the martini hangover one.
Probably is. I think it comes down to that. Again, euphoria is great. And when you have those goggles on and you have too many martinis, everybody looks smart, everyone looks beautiful, everyone looks happy. But the hangover always breaks you reassess your decisions the day before or the night before. I think folks have to be realistic. about the amount of monetary alcohol that this system has taken on, and prepare for the hangover. And one of the bottles of water or one of the Bloody Marys you can take is precious metals as insurance, not as a gold bug, not as a speculation trade, but simply as insurance. It doesn't have to be all your assets. It's common sense to us. And the majority of our investors look at it that way. It's very boring, but very sensible.
All right. I think I'm now going to have to go and get a martini. My martini of choice is dirty, extra dirty, or an espresso martini is probably what I'm going to need after this interview. But thank you so much, Matthew. Tremendous insight. Really appreciate you taking the time to break all of this down for us. Matthew Piepenburg, thank you so much for joining us.
Thank you, Michelle. It's been my pleasure.
And thank you for watching. I'm Michelle McCory. Keep it right here on Kitco.